With the world experiencing several financial crises, it seems another bear market is upon us. On June 13, 2022, the U.S. stock market officially entered into another bear market for the first time in 2 years. This happened after the S&P 500 closed more than 21% below its all-time record close that was established in January. Bear markets are when the stock declines by 20% or more from a recent peak. And while analysts can't really predict when a bear market will end, we can use history as a yardstick. So in this video, we'll take a look at the history of bear markets in the US market. The stock market crash in 1929 had become a central event in bear market history, as it cut down 89% of value from the Dow Jones Industrial Average. The Great Crash, which caused a sharp decline in US stock market value in 1929, contributed to the Great Depression of the 1930s. There are several things that could lead to a bear market. The prices of stocks and other securities are influenced by a wide range of factors. But what often causes a bear market is investor speculation. Stock prices tend to fall when investors lose faith in performance. This may cause investors to sell their securities to avoid losses, and when this happens on a large scale, it could cause prices to drop drastically. This was the cause of the 1929 stock market crash. Investors had enjoyed the all-time high of the stock market when the prices soared to great heights. But panic set in on the day that there was a record of 2.9 million shares that were traded on the Dow Jones. On Black Monday, the market closed down by 2.8%. And on Black Tuesday, October 29th, 1929, more than 16 million shares were traded on the New York Stock Exchange in just one day. Billions of dollars were lost, and it wiped out thousands of investors. The 1929 bear market lasted for 67 days, but the S&P 500 index saw a decline of 44.67%. However, a bear market doesn't necessarily point to an economic recession. It goes hand in hand with a slowing economy, but a decline in market doesn't mean a recession is imminent. But the worst indicator for the market is a bear market. Bear markets come in different ways, and they have varying depths and duration. According to GoBackInRates.com, the average bear market lasts from about 9.5 months to 13 months. Since 1946, there have been 17 bear markets ranging in duration from 1 month to close to up to 2 years. And these bear markets have suffered severely from a 51.9% drop in the S&P 500 to a decline of 20.6%. The 1947 to the 1948 bear market, which started in June of 1946, lasted for about 3 years, with the Dow Jones dropping around 25% before bottoming out. It was different from normal bear markets because the entire decline happened in the first 4 months. The 1957 bear market, which had already begun the year before, lasted for about 18 months, with the S&P 500 dropping around 22% before bottoming out. The S&P 500 index was introduced to the stock market in 1957. It was an index that was more representative of the U.S. economy than the Dow Jones. The 1957 bear market was followed by an 8-year bull market between 1958 and 1965, where the S&P 500 gained around 130%. But within the 8 years of the bull market, the 1962 bear market set in. In May of 1962, the S&P 500 price index dropped down by 23% from its prior high the year before. The market had been dropping for over 5 months before it bottomed out at 27.97%, and it lasted 196 days. However, after bottoming, the market recovered to its prior peak after a year and 2 months. The 1962 bear market was called the Kennedy slide of 1962 because President Kennedy had promised that the economic recovery would continue, but instead it declined. And again, after the bull market period came yet another bear market. It started in 1966 and lasted for only 8 months, but in that period, the S&P 500 index dropped by 22.18%. However, because the 22.18% declined in a little over a year and a half, it was considered a fairly minor bear market, and it lasted for only 240 days. The 1966 crash came after nearly 2 decades of uninterrupted economic growth and stock market gains since World War II. And as Vietnam and Johnson's Great Discovery social programs pushed up economic spending, the Federal Reserve decided to tighten conditions. After bottoming, it took 7 months for the market to fully recover, and it was the smallest bear market since 1950, which earned the name Baby Bear. It had the shortest recovery cycle of just 1 year and 2 months because the market recovered more quickly than usual. However, the 1973 market was the second largest bear market in U.S. history after the Great Depression. The 1973 to 1974 bear market lasted for 630 days, or 21 months. In that time, the stock market lost about 48.20%. It didn't start with a sharp crash. began slowly in 1973, at a point when inflation was rising and the economy was experiencing slow growth. Between those 630 days, the New York Stock Exchange lost about 45% of its value. Interestingly, the year before had been a good year for the Dow Jones Industrial Average Index, as it saw gains of 15% in 12 months. Analysts and investors had hoped that the following year would have been better, but when the stock market fell, the effect was worse in the United Kingdom. The London Stock Exchange FT30 lost about 73% of its value during the crash. This caused the UK to go into a recession, as its 5.1% GDP growth in 1972 fell to 1.1% in 1974. What didn't help was the OPEC oil embargo of 1973, and the Watergate scandal that led to President Nixon's resignation in 74, which stimulated the decline. The OPEC oil embargo caused oil prices to rise sharply, which resulted in oil shortages across the US. It also didn't help that Nixon's abandonment of the gold standards of the Bretton Woods systems of monetary management caused a loss of confidence in the U.S. economy. It was often credited as the cause of the global drop in stock prices. The 2-year bear market ended in December of 1974, when the Dow hit 577 points and the S&P 500 closed at 65. After bottoming, the market took 2,114 days, which is about 5 years and 8 months, to fully recover. By 1980, the market was enjoying a peak period, barely a month after the 1980 presidential election, where President Reagan defeated Jimmy Carter. However, when Carter was still president and inflation was running double digits, Carter appointed Paul Volcker as chairman of the Federal Reserve. The Feds raised the federal funds rate from 11.2% to 20% by 1981. Their goal was to stop inflation from rising, but the increase in the federal funds rate made it more difficult to borrow. As a result, it caused the 1980 to 1982 recession. The recession led to a national unemployment rate of over 10.8%. Towards the end of 1982, the S&P 500 index bottomed at 102.42 and was down by 27.11%. This bear market lasted for 622 days. Typically, bear markets suffer a decline that is followed by a slower and steadier recovery. But the 1982 bear market was rare, because even though it saw a slow and steady decline, it saw a sharp recovery. Then by 1987, the stock market had experienced a crash. And it was called a crash instead of a bear market because it happened within a week and took just 2 months to bottom. And also, the S&P 500 index lost 40% over a short 2-month period. Then, between March of the year 2000 and September of 2001, the stock market went down by 36%, which made the bear market last for 564 days. This bear market caused an 8-month recession to hit the economy. This time, the main factor that caused the recession and led to the market decline was a bust in the dot-com industry. The dot-com crash was also spurred by a loss of confidence in investors. The recession climaxed when the 9/11 attacks happened. And so, between 2000 and 2002, the S&P 500 index was down 49.1%. Then the bear market from 2007 to 2009 lasted for 408 days, and it sent the S&P 500 down by 51.9%. This period was known as the Great Recession, since the U.S. economy slipped into a recession. Now, this bear market was accompanied by a growing crisis in the housing market, with increasing numbers of borrowers unable to meet their obligations. The 2008 crash happened as banks were losing their lending practices for mortgages, which had ripple effects throughout the entire economy. But the stresses that led to the crash had been building for a while. The 2007 recession snowballed into a great financial crisis by 2008. The Dow Jones Industrial Average fell by almost 778 points. And in that time, money market funds lost $196 billion. By December 2008, the Feds dropped the federal funds rate to 0%, which was the lowest in history. However, the Dow ended the year with a low of 8,776 points, and it was down 34% for the year. And the U.S. stock market did not fully recover until 2013. By March of 2020, there was a short bear market that lasted only 33 days, but it suffered a drop of nearly 34%. The 2020 bear market put an end to the 11-year bull market because of the economic impact of a pandemic. It was, however, the shortest bear market on record, and the market was able to fully recover within 6 months. Throughout 2020 and into 2021, markets rebounded as people were optimistic about vaccines, and it led to a global economic recovery. However, in June of 2022, the S&P 500 entered into a bear market for the first time since March of 2020. This time, it was caused by a hike in the Federal Reserve of interest rates, which was aimed at slowing growth since the economy was experiencing inflation. And with the U.S. stock market in a bear market, the S&P 500 closed within 21.8% of its January high. Analysts can't predict when a bear market will end, but history can provide some solace that the average bear market lasts for between 9.5 months to 13 months. Investors may be tempted to sell when the stock market is experiencing a bearish season, but the remaining are focused on the long term, because after a bear market comes a bull market where there's an increase of 20% or more in stock market value. I guess you can tell this video took a lot of work to pull together all this information, so I appreciate if you give it a like. I'd be ever so grateful. And comment below and let me know what you thought. And for more interesting videos like this, be sure to subscribe and turn on that bell icon so you never miss an upload. And take a look at my video here about how to use gold during a financial crisis. Thank you very much for watching, and I'll catch you guys later.